Should you contribute to a pre-tax traditional 401k or a Roth 401k? Maybe your colleague is telling you you should definitely do a pre-tax 401k while your friend is telling you you should definitely do a Roth 401k. Who should you believe? In this video, I am going to share how exactly a Roth 401k works and how it could be an amazing way to grow your money. And more importantly, I'm going to share with you tips on how to choose between a traditional pre-tax 401k and a Roth 401k. And at the end, I'll give a bonus tip. Can you contribute to both a Roth 401k and a traditional 401k? Let's say you want to put in half of your contributions to a Roth 401k and half to a traditional 401k. Can you do that? The answer is yes, you can mix and match just like a COVID vaccine. What if you're self-employed? Good news for you, if you're self-employed, you can create your own Roth solo 401k. Please do watch our videos on solo 401k versus SEP IRA and another video on tax-free investing. How exactly does a Roth 401k work? Like most Americans, you're probably more familiar with a traditional pre-tax 401k. The main feature of this is, you guessed it, it's tax deductible. So let's say your salary is $100,000. You contribute 10% of your salary to a traditional 401k. Then you get a $10,000 tax deduction. So in your W-2, instead of your total wages appearing as $100,000, because you contribute $10,000 to your traditional 401k, then your W-2 will only say $90,000 and your taxable income will be lower and your taxes will be lower. But when you retire and withdraw all that money, let's say you manage to accumulate $500,000 in your traditional 401k, every dollar that you withdraw from that traditional 401k, you have to pay federal taxes on it and maybe even state taxes. With the Roth 401k, you don't get any tax deductions up front, but when you withdraw all that money that you've accumulated when you retire, you pay $0 in taxes. So let me illustrate to you the potential power of a Roth 401k. So let's say you contribute $10,000 each year to a Roth 401k for a total of 30 years. And because you invested it smartly, you made an average of 7% return per year on the average. At the end of 30 years, guess how much you've accumulated? Well, you've accumulated close to $1 million, and all of that is tax-free. Let's talk about some frequently asked questions about a Roth 401k. First one is, if you do a Roth 401k, do you still get employer matching? The answer is yes, if your employer does employer matching. The only thing is, it doesn't go to your Roth 401k, it goes to the traditional 401k portion of your. Who is eligible to a Roth 401k? As long as your employer's 401k plan gives you the option for a Roth 401k contribution, then you're eligible. It doesn't really matter how much you make, whether you make $50,000 or $250,000. There is no income limit for contributing to a Roth 401k. How should you choose between a Roth 401k versus a traditional 401k? My friend Lee messaged me the other day and she was like, Alvin, I need your advice. My colleagues are telling me definitely do a pre-tax 401k. Well, my friend Alan is telling me you should totally do a Roth 401k. If you're struggling with the same question, you're not alone. The answer lies in your tax bracket. You'll have to compare your tax bracket now versus your tax bracket when you retire. So let's say you're in the 24% tax bracket now, and you're thinking, when I retire, maybe I'll be in the 25 or 28% tax bracket. In that case, maybe it's advantageous for you, probably, to contribute to a Roth 401k now and pay taxes now while you're in a lower tax bracket and avoid paying a higher tax rate in the future. Now, what might be the reason or reasons why you think your tax rate might be higher in the future when you retire? Well, the first thing is the Tax Cuts and Jobs Act is going to expire in 2025. So starting 2026 onward, our tax brackets are going to increase. And the other thing is You might be thinking, the government is piling a huge amount of debt each year, and most likely they're going to have to repay that debt, and they're going to get it through a higher income tax rate in the future. That could be one reason too. If you're in the 32% tax bracket now, maybe you're thinking, I probably don't need a lot of money when I retire. Maybe I'll be in the 25 or 28% tax bracket when I retire. Then it might be advantageous for you to do traditional 401k contributions so you don't pay a higher tax rate now and you can pay a lower tax rate when you retire. Now you might be wondering, how in the world can I know exactly what will be my tax bracket when I retire? Well, it depends on the laws in the future. Number two, well, it really depends on the lifestyle that you'd like when you retire. Are you the type of person who will want to travel a lot? Let's say you want to visit the Northern Lights, you want to visit Antarctica, you want to visit the Galapagos Islands. All of that traveling will require you to withdraw more money. And if you withdraw more money, then you might end up being in a higher tax bracket. But if you want to just be a homebody, maybe you want to buy a vacation home close to the water and just hang out there and not really spend a lot, maybe you'll be in a lower tax bracket. If you're finding this video valuable, please do click on the like and subscribe button. Here's my bonus tip. Regardless of your tax bracket now, it might be advantageous for you to contribute at least some portion to a Roth 401k. Here's why. For tax diversification reasons, because we just have no idea what the tax rates would be when we retire, it might be advantageous to have both pools, a traditional pre-tax pool and a Roth 401k. The other reason would be you can actually manipulate your tax bracket when you retire if you have a Roth 401k portion of your retirement. This is one of the things that we explain in detail for our clients. There are 3 big mistakes that most people make in their 401ks. Watch our video on the 3 biggest 401k mistakes so you can avoid them.